Guest also staying positive on the digital and the e-commerce space amid this latest pullback. For more, let's bring in Laila Pence, president of Pence Wealth Management. Laila, always great having you with us. Take a look at this GTV chart on the Bloomberg, because we are seeing the NASDAQ 100 really around those 50-day moving average levels. If it falls below, what could it mean as we continue to see this tech sell-off accelerating? Are we taking the froth out of the markets, or is this a more serious sell-off?
I think we're taking the froth out of the market. The market went up so quickly, so fast, and we actually been looking for this. This is a welcome, correction that we think is going to be short-lived.
Does that mean that investors should be buying the dip, taking this chance to actually go into these stocks, especially those companies that really have strong balance sheets and may act as a safe haven given all of the uncertainty out there?
Absolutely. I think investors need to dollar cost average in. We don't know exactly if this is the bottom. There certainly could be more volatility, but we do expect it to be very short-lived. So if you don't have exposure to those companies already or to those sectors, this is a very good time to if you want to have a 5% allocation, go in with a 1%, a 2% dollar cost average in. These valuations, the market, and especially the NASDAQ, is really the only place in town. There's nothing else. We have very low interest rates everywhere else. We've been looking for this for a while.
So given that so much of the US exceptionalism story has been driven by the heavy weighting of tech stocks in that market, is it time now to look for opportunities outside of the US?
I do think you should be looking outside the U.S. just because valuations there are so much lower than us in terms of PE. And we do think a good diversification there, but certainly you cannot abandon the U.S. The U.S. is definitely where the growth is, but it would be prudent certainly to look for some lower PE valuations outside the U.S. for now.
In particular, China, where do you see the opportunities, and is it worth going into that market given the enormous amount of uncertainty that we're going to get possibly beyond even November?
We think that China is really is undervalued comparing to the U.S. We think that COVID did not hit them as hard as us. They already have 25% e-commerce, use of e-commerce, where the U.S. only has 16%. We do think that China is ready to. It's probably the only area that's going to have a positive GDP by the end of the year because it didn't go down as much. So we do think it's a good place, even though there's potentially a lot of uncertainty with the political arena. But we do still think that this is a very good place to add some funds there.
Are there any sectors that you should avoid? Because, of course, we continue to see the tech tensions, Huawei and other Chinese companies like ByteDance under pressure. But at the same time, we are getting more news that we could even see the cotton and textile industry under pressure as well.
Well, you definitely have to be selective of what area to go into. We still like technology and internet in China. It's still the dominant, and it's very similar to the U.S. This is, the way the COVID is could last a little longer. So you need to be in the areas that you really can count on.
All right, Laila, really appreciate your time with us as always. Laila Pence, president of Pence Wealth Management, joining us. Let's